Investing in stock market is the most common investment option. However, stock market is dynamic and thus risky in nature because stock prices can change rapidly. For an investor to make the right decisions and generate returns in the long run, the first step is to understand the key drivers that cause share prices to rise and fall. So, let's look at some of the factors that affect stock prices. The main factors that determine stock prices are demand and supply. If more people buy shares than sell it, the demand increases and share price goes up. Similarly, the stock prices will plummet if there are too many shares available, but no one wants to buy them. Company attributes. Any change in the company's attributes makes its stock prices volatile, such as increase or decrease in sales, increase or decrease in earnings, product launch or product failure, repayment of debt, change in management, employee layoffs, etc. Investors develop their outlook based on these factors. Therefore, positive factors can lead to a rise in stock prices, and negative factors can adversely impact a company's stock performance. News and current events can hamper human lives and market equally. Events such as changes in economic policies, inflation or deflation, political turmoil, civil war, riots, terrorist attacks, and natural calamities affects companies' performance and the capacity of people to spend money. This results in lower levels of consumption, lower sales and revenues, ultimately hitting the company's stock performance and market volatility drastically. Dividend effect. Typically, stock price of a company tends to rise on dividend declaration. This is because investors generally perceive companies declaring dividend as being financially strong and stable. However, if the dividend declared does not meet investors' expectations, share prices can fall. Market sentiment. Market sentiment refers to the general outlook or attitude of investors towards a particular security or the overall financial market. Market sentiment is bullish when prices are rising, whereas it is bearish when prices are falling. Positive or negative sentiment can drive price movement. For example, fear of missing out can cause investors to buy an asset, not because it is a good investment, but because they need to do something to avoid the feeling of missing out. Similarly, during bear markets, investors often sell stocks at prices below their value because they need to stop feeling the pain of losing money. Classification of stocks. Stocks can be classified on various parameters, like market capitalization, industry risk, dividend payment, volatility, etc., and each has its own advantages and disadvantages. Therefore, an investor should understand different types of stocks before making any investment decision. Let's understand different types of stocks. Growth stocks. Growth stocks are companies that have higher growth in revenue and earnings than the average businesses in their industry. Such companies possess a competitive advantage over others in the form of innovative products or services. These companies don't usually declare dividends, but reinvest their earnings to fund further development. Therefore, investors tend to receive higher capital gains with an increase in the stock value. Examples: Netflix, Facebook, Amazon. Income stocks. Industries that belong to this category are generally stable sectors, such as petroleum, financial institutions, etc. Most income stocks are from large companies with deep market presence and stable cash flow. Therefore, they distribute regular dividends to their shareholders instead of reinvesting into the company. Investors with low risk appetite and who want to earn a regular income consider investing in income stocks. Cyclical stocks. Cyclical stocks are of companies whose underlying business is affected by economic cycle of expansion and recession. Profits of these companies rise in a booming economy as consumers have more disposable income to spend. Their profits decline during a slowdown or recession as consumers cut down on spending. Industries that belong to this category are airlines, hotels, restaurants, automobiles, luxury goods, etc. Speculative stocks. Speculative stocks are issued by startup companies developing new products or technologies, or companies that have undergone organizational or financial restructuring. These stocks are risky because such companies are often untested and may not succeed. But if it succeeds, the payoff can be substantial. Energy or mining industries are examples of speculative company because they continuously commit a significant percentage of their assets to exploration projects. Defensive stocks. Defensive stocks are companies that remain stable despite economic trends. These companies produce products that have a constant demand, irrespective of economic conditions, and therefore are unaffected by changes in the business cycle. Industries that belong to this category are drugs and pharmaceuticals, and utilities like electricity, gas, fuel, healthcare, etc.